And we start by bidding adieu to 2022 with a big good riddance. Major averages all officially closing out the year with their worst losses since the financial crisis. The Nasdaq down for 4 straight quarters for the first time since the dot-com bust. The S&P dropping nearly 20% for its 4th worst performance since the Second World War. The Dow a relative outperformer this year, but still shedding almost 9%. But could there be relief in sight? History shows that the S&P posts gains more than 80% of the time in the year after a drop, and the average return that year is 14.2%. So are we in for another rebound in the new year? I will kick things off with Jeff because he is the only trader who made it into the Nasdaq to sit with me tonight. Jeff.
Very happy to be here, ringing in the new year at the Nasdaq. Listen, I'm a stat guy. I always throw stats out. I love that, especially history. But I think in this case, you throw stats completely out the window. A couple of weeks ago, I tweeted that, regardless of what you think about next year and the history, you are unwinding sort of unthinkable monetary stimulus, fiscal stimulus. We've never seen this before. It's extremely unusual. We talked about it last night, the unwind of $18 trillion in negative yielding debt all the way down to zero. If you could put up a multi-year chart of the 2-year, I mean, it's unbelievable the move that we've seen in rates. And I think we have this chart made, but this has really been my North Star, and it really is for the next 12 months. It's the move in interest rates and the correlation to earnings. Earnings still need to come down, and that's going to be a headwind to the market. If we look at this chart, you can see that downward move. That's actually inverted, so it shows the upward rise in the 10-year over the last 2 years. That is going to drag positive earnings revisions down as we move through 2023. That's why I don't believe we're going to see a boom next year, even though a down 20% year, you might think that we should.
So entire businesses, entire industries have been built on 0% interest rates, Grasso. So maybe Jeff is right. Maybe it's different this time around. And I know we all hate that, but maybe it is.
Yeah, I don't think you can ever say that. So I'm with Jeff. I think, when you look at stats, I think this time could be different. But I agree with what he said and when he finished up. You need to see earnings estimates come down. We haven't seen that yet. So there is a disconnect. But the other pushback is that's become so consensus right now. What happens if the market is shocked to the upside if when earnings start to report, they're not nearly as bad as this earnings recession that the sell side is calling for? So then you could see the Fed getting closer to the end, earnings recession really a little meh. And then you see the market kind of, rally from there. I think in either scenario, the market's going to rally towards the back end anyway. Do we get a sell-off the first quarter? Does that lead into the second quarter? Or do they do an all-lay for the bears?
It's funny because Grasso just said that he thinks that the idea that earnings estimates have to come down is so consensus at this point, and yet the overall forecast that he arrives at is, in fact, consensus, that the first half of the year is going to be difficult and probably down, right? And the back half of the year, there's going to be a rally. So that's consensus. Guy, where do you stand?
So what's that saying? Great minds think alike. So Steve is in that category clearly. I'm sort of in the Mills camp, and clearly Jeff has been working out because he looks buff as hell, man. He looks good. But I'll say this. The bull case seems to be predicated on a couple things that we're so far down from the all-time high we made effectively this time last year, number one. And number two, somehow the Fed's going to magically come in and bail us out. And I don't think the second one's going to happen. And in terms of the first one, I don't think you can really build a case on the back of that because it really doesn't matter where things were. It just matters where things are going. And, if you look at what's going on, Mike Wilson took his numbers down, potentially $180 in S&P earnings. Again, even if you put just a market multiple on that, it's still significantly lower than we are now. And I think almost by definition, the market has to take another leg lower to flush a lot of this excess out of the system. And oh, by the way, which is my verbal crutch, the Fed is still trying to unwind a balance sheet that got almost to $10 trillion, which was ridiculous.
So maybe it's worth thinking about the other part of the stat, sort of the flip side to what we were saying earlier. We were saying that a 2-year down year, in terms of 2 straight years of declines, very rare. But in the 4 times that it's happened since 1928, what happened the second year? The declines were even worse than that first year, Jeff.
Right. And I think that's why you can't trust averages. They can be deceiving sometimes. And I think the Fed is a big part of this. I think the market is forecasting rate cuts in the second half of the year. And we have this weird recency bias, I think, where all of a sudden people think that central banks can come in, save the day. We've seen a lot of these V-shaped recoveries because of that. This time they are in a complete box. They're not going to be able to do that. They're going to keep rates higher for longer. The market has not internalized that. And I understand what Steve is saying, but at the same time, if you look at forecasts for earnings out next year, these high interest rates are going to work their way through the economy, through earnings, and at the same time, earnings are still forecast to be 5% growth or something like that in 2023. Right. If we enter anything that even looks like a recession, all of a sudden you get, what, 10% earnings decline? That would be somewhat mild. So I still think the market needs to factor that in as we move through the next couple of quarters. I mean,
we have had a notable drift higher on the 10-year yield just in the past 3 weeks or so, from 3.4 and change to where we are now, which is almost 3.9. We have Japan raising the upper band of its yield control target, which is the last anchor in the world in terms of holding treasuries down, treasury yields, I should say, Guy. And then we have that wild card of China. I mean, it's interesting to me that China, the world's second largest economy, opens up, and forecasts don't change at all yet. So that's a wild card in terms of how does that impact earnings estimates. And aren't we just another wave or lockdown away from a threat to earnings, at least for this first calendar quarter?
I believe that to be the case. And again, you know, I'd love to be extraordinarily optimistic going into this year. It's hard to make the bull case right now. And what you just laid out is exactly right. I mean, there's a real chance that if China, let's just say it were to reopen, I think the knee-jerk obviously would be higher in the market until people figure out that, wait a second, that's just going to add to the inflation problem that this Federal Reserve is rightly trying to combat. That's going to make their difficult job that much more difficult. In terms of what you mentioned with the Bank of Japan, you think about it, they intervened in their currency a few months ago, first time in a long time because their currency was getting throttled. This last move they made in the bond market was to do exactly that, intervene in their currency once again. And now you start thinking about all these central banks pushing buttons left and right. To me, that leads to one place, probably precious metals, but it also leads to continued volatility in the bond market, which will make its way into the equity market.
Yeah, so Grasso, in terms of just like looking at that first half of the year where you think it could be kind of choppy, where do you hide out? And I hate using that term, but it really does sound like, you know, to some degree you're hiding out a little bit, waiting for better times ahead.
Yeah, so I think if things get better, people are going to rush into the old names that buoy this market. So you have to stay a little bit clear, still go to value investing, and then you're going to have to unfortunately rush right back into all the technology names that were hammered so aggressively.